Okay, today we have chapter 14, and chapter 14 is related to making capital investment decisions. Okay, and this is one of the most important topics in finance. These are the learning outcomes. The first one, we will explain the nature and the importance of investment decision making. After that, we will identify the four main investment appraisal methods found in practice. That means those four appraisal methods is well known in business. Okay, most of the companies use some of them. Most of the companies use, for example, 2 or 3 methods, or sometimes at least one method. Okay, and then after that we will discuss each one of these methods one by one. Why the investment decision is very important? Because it involves large amounts of resources. Okay, that means a lot of money, for example, involved in investment decisions. If you want to invest in buying an asset, then you need to buy an asset with a huge amount of money. For example, because that we need to analyze the decision and see whether this is a good decision or bad one. And the second reason of the importance of investment decision is that the investment decision are very difficult to return back again. If you invest in buying an asset, for example, then it's very hard for you to sell the asset if you if you don't find that this asset is a good investment. That means you will lose a lot of money. Okay, these are the four main methods that are used in investment decision, and they are: the first one is the accounting rate of return, the second one is the payback period, the third one is the net present value, or NPV, and the final one is the internal rate of return, which is IRR. Accounting rate of return can be found by this equation: the average annual operating profit divided by the average investment amount, okay, multiplied by 100%. That means if you have an investment that give you an average of 10%, for example, yearly, and this investment costs around 1 million. That means 10% of 1 million is around 100,000. That means what is the ARR here? ARR is equal to 100,000 divided by 1 million multiplied by 100%. It will give us the accounting rate of return. And this is the easiest method among all the other methods. So what is the decision rule here? The decision rule of ARR is that the chosen or the acceptable the acceptable project here is the one that achieve the least or the minimum target accounting rate of return. Most of the time, the companies decide a minimum rate of return for their investments. As an example, a company manager say that we will not invest in any project unless it gives us 15% as income, okay, or as an accounting rate of return. That means if any investment has below 15%, this investment will not be accepted by the company. If we have two projects, then the more or the maximum or the highest ARR should be selected. The highest ARR should be selected. If we have two or more projects or investments, then we should choose the highest ARR. These are the problems of ARRs, that it's ignoring the time, it's not putting in mind, or it's not considering the timing of cash flows, and also it's using an average investment, and using an average is not a good decision always, because sometimes the investment, the exact investment or the exact income will be more than this investment, okay? And it's using an accounting profit. That means if you get an experience, or if you get a know-how from the investment, then it will not be counted in ARR. Okay, and finally the competing investments. If we have two investments, then we should choose the highest ARR with no regard or with disregard to the risk of different different investments. As an example, if the highest ARR was riskier than the low ARR, that means if we choose this method, then we will choose the highest risk investment also. Okay, next is the payback period, and payback period is the time needed for returning back the invested capital. That means if you invest your money in an investment, the time needed to return back your money, we call this time, we call it the payback period. That means payback period usually measured by number of years or number of months needed to return back your money. In the payback period, the decision rule is that the shorter payback period investment is the best investment here. That means the shortest time you return your money back, this is the best investment. If there is two investments, then the shortest time or the shortest PP or payback period is the best investment. Of course, also this one has some problems. The first problem is that also the payback period is not considering the timing of cash flow. And also the second problem is that the payback period ignores completely the cash flow after the payback period. For example, if you have an investment and this investment has 2.5 years payback period, but after 2.5 and the other investment has 1.5 years as payback period, but the first investment gives you more money after the payback period, then based on the payback period you will choose the second one, whereas the first one will be better for you as an investment because it gives you more money after the payback period. But here we ignoring all the cash flows after the payback period. And also the payback period does not put risk in mind, so it's not considering the risk of the investment. Another problem is that it's not related to wealth maximization, because in payback period you only count the years needed to return back your money, not how much your wealth will be increased. It's only counting when you will return back your money, and this is not an objective of the investment. The main objective of any investment is the wealth maximization, and here in the payback period, the wealth maximization is ignored. Sometimes you or a company decide to invest in any investment that has a payback period of 3 years. So this decision does not reflect any idea about the investment. That means it's not an irrational decision. Okay, so it's just a decision, and it's not related to any objectives that are good to the organization. This is an example of 3 competing investments. The first investment has a payback period of 3 years, and the second project also, or the second investment, has also 3 years payback period, and the last one also the same thing, has 3 years payback period. Whereas the project 3 or the investment number 3 gives you money or gives you return after the payback period, which is more than project 2 and more than project 1. Okay, whereas in the rule of payback period, they are equal because they have the same payback period, and this is a problem in the payback period. These are the 3 factors that are affecting the return to any organization. The first one is the interest that the company paid to the lenders, okay, or to the banks. For example, if they get loan from a bank, then the return required by the company must consider the interest as one factor that affecting their required return. The second factor is the inflation, and the inflation is increasing of the prices of the products. That means the inflation affects the money with negative affection, or it makes the money less than it should be. So the inflation is affecting also the required rate of return. As an example here for inflation, if your required rate of return is 10%, for example, that means you want to invest your money with an investment that gives you 10%, but the inflation rate increased from last year with 5%, for example. That means your exact rate of return is not 10%, is 5% because of the inflation. That means you need to consider the inflation when you decide what rate of return you require. The last item here, or the last factor, is the risk premium, and risk premium is the risk that related to the investment itself. Some of the investments are more or are riskier than other investments. So here you need also to consider the riskiness of, the level of risk in the investment. Okay, based on these 3 factors, we have new method for investment decision, and this method is called the net present value. And the net present value is the value of the cash flow that you receive after a period of time with the current prices. And here we put in mind that there is something called discount rate. And the discount rate is based on these 3 factors. but here we call it discount rate, and it will be, for example, in the question, it will be as a rate. They will give you a discount rate at, for example, 5% or 6% or 10%, and you will be asked to calculate the net present value using this discount rate. Okay, how can we calculate the net present value? We calculate net present value by the following equation. Let us say that we have a company, and this company wants to invest in a project, and the amount of this investment, or the amount needed for this investment, is 450,000, as you see here in the Excel sheet. Okay, that we pay at the beginning of year 1, for example, the beginning of year 1, or we call it year 0. Okay, we pay 450,000 as a price for an investment. Okay, this investment will give you as cash flows or as return on investment. In the first year, it will give you 190,000. Okay, and it will give you the same amount for the next 5 years. At the end of the first year, it will give you 190,000. At the end of the second year, it will give you 190,000, and so on. So, what is the net present value for this investment? You have to calculate the net present value using the following equation. The equation for counting the net present value is as follows. This is the equation that we use to count or to measure the net present value, and we need to measure net present value for each cash flow alone, and then we will add all the net cash flows together. Okay, but first of all, for example, here the first cash flow for the first year is 190,000. Okay, when we use this cash flow in this equation, then we will find that this amount, or this cash flow, will be 135,714. Okay, if we take this 190, okay, let us say that NPV is equal to net cash flow here. Net cash flow is 190,000. That means we will put 190,000, okay, and divide it by 1 plus R is the required rate of return, or as we said, it's the discount rate. Okay, the discount rate. And the discount rate used here is 0.4. That means 40%. 40%. Okay, if we use 40% here, 1 plus 0.4 to the power of the year. To the power of the year. That means here we are in year 1. Then we need to put this amount to the power of 1. Okay, this one will give us, as we can see here, if we remove the net present value here, okay, then we will find this amount. We will find this amount, which is the same as this amount, but we should remove the point here, okay, and make it just like this. Okay, so here this is the net present value for the cash flow of the first year. With the same thing, with the same process, we will count the cash flow of the second year here, this one. And the second year, the net present value of the cash flow for the second year will give us 96,939. And the same thing for the third and fourth and fifth year. Okay? To find the net present value for this investment, we need to add the net present value for all the years, okay, and deduct it from the initial investment, which is here 450,000. It will give us minus 63,390. If the net present value was negative, that means this project or this investment is not acceptable. We need an investment that gives us a positive net present value, like this one. For example, here we are using 0.2%, or we are using 20% as a discount rate. That means you want to consider also the discount rate. If the discount rate, you see here, the discount rate is decreased from 40% to 20%. When the discount rate decreased, then this project was accepted because it gave us a positive net present value.